Good evening, everyone. This is Gary from Apex Pro Group. Just wanted to go over some things about the pattern and structure. Let's quickly discuss them now. So when we are talking about an uptrend, we're talking about a peak formation low, and then the pattern of W, V, V, M. And then when we're talking about trading away from in the downward movement, we are talking about trading away from a M for a peak formation high and the pattern of M, A, W. So let's quickly draw those out now and see what they look like. So peak formation low is the W here. Push up, stop hunt to make V1, push up, stop hunt to make V2, push up. And then we made a higher high and a higher low. And then we make our M structure here. Then from a peak formation high, which could continue from here, we have our M here, two equal highs, push down, pull back, and a push down to make A1, and then a pull back and a push down to make our A2 and push down into level 3 to create our W formation. Now the peaks are level 3, level 1, level 2, and level 3. So this would be our level 3 here, our level 1 here, our level 2, and our level 3 here. And then our level 3 peak formation high, our level 1, our level 2, our peak formation low, level 3, level 3, level 3, and level 3 here. So we always start and finish in level 3. So that is quite a useful thing to know. So let's just delete some of these. And we can reuse these drawings. So if we were coming from a downtrend, people would be selling, and then the dealer wants to trap people. We want to talk about the structure. So this would then be a lower low, and then this would be a lower high. So people are selling, and then he switches it, makes people buy, taking out these stops and inducing people to buy. Then he switches it again, induces people to sell, taking out the stops of the people that went long. Then he switches it again, taking out the stops of the people that went short, and then shifting the zone up here. He then, in our A1, he then switches the market to take out the stops of the people that were long in this direction here and induce people to sell, which is a trap move or a manipulation. And then he shifts the zone. So that then moves us up to our A2. People are piling on the buys. Then the dealer switches it to induce sellers and take out the stops of the people that were long here. So then he switches it again here and then takes out the people who went short here and then moves on up into level 3. People are still buying, makes a higher high, makes a higher low. So then induces sellers, takes out stops of these guys, induces buying. So he's still making this bullish structure of higher highs, higher lows. And then these people that are buying here take out the stops of these people. And then the dealer shifts the zone here, taking out the stops of the guys that went long here. So from this point here, we failed to make a lower low, and then we made a higher high, here. We made a higher low. So this is our bullish confirmation. And then we made another higher high, another higher low, another higher high, another higher low. So the trap move part is here because we failed to take out this high. So that is the first sign of reversal. Just remember as well that the multi-day session pattern is W and M in level 3. And it's very likely that the second leg will form at the previous day's high or low. So first leg on the first day, second leg on the second day. The price is likely to spike the stops there and then shift the zone. So obviously this is inducement and trapping people the wrong way. The middle bit was our lower low, lower high. So once that is broken, this low and this high becomes like our level, and then the shift away from the zone becomes like our impulse, and then the high and low of this part where the manipulation is and the stop hunt becomes our first level, our A1. So then they shift it, and then this structure here, the high and the low, become like our level, and then they shift it again. And then we have the opposite of down here. We have the high, the higher low, failure to take that out. So then this becomes our level. So it's the consolidations and impulses separating these levels. Obviously the dealer doesn't always do it so cleanly, so it's important to use different methods. Otherwise we won't be able to clearly identify where we are. We've got the ADR, the EMAs, the days of rise, the days of drop, intraday patterns, higher highs, higher lows. Got impulses, consolidations, we've got Asian box stacking, we've got ADR box stacking, we've got all sorts of methods. So not all the time are all of the methods going to work, so we have to use the ones that work and see the ones and observe what they're telling us and make an informed decision. So in MAAW, exactly the same thing but upside down. See, failed to make a higher high, made a higher low. So this point here was the first point we failed to do that. Then we shifted. You see this pattern was to induce, trap, and shift. So this became our boxed off bit. This became our impulse. This became our manipulation, our A1. So this was a stop hunt, and then this was the shift here. So this becomes our level, and then down here we had our low, and then we had a pullback in the opposite direction to make our A, and then we shifted that zone again, so that became our consolidation, and then we made a lower low, a lower high, then we failed to make another lower low, so this part becomes our the middle of the W becomes our level with the lower lows. Obviously this was to people thinking it's going to keep going, then trap people going long, then trap people going short, taking out the stops. So there's few buyers left in the market. People believe things and they see it for the second time. So yeah, these simply are our levels. I'm going to show you a few flashcards now, and then we will finish the meeting, I think, for now. I'm just going to pause for 1 second. So obviously sometimes we don't have a beautiful pattern on the, either sometimes on the H1 or in between levels on the lower time frame. So the way I like to describe a level or a push is that it's an impulse followed by a stop hunt, which is a pullback, or a consolidation if the dealer holds that level for a little bit longer. So as you can see here, we had an impulse shifting a previous structure or zone, and then we had a pullback, and then we cleared that particular structure here. So we marked the top of the previous stop hunt and the low, and then where we shifted it, then we had our initial high and low at that area. And then when they held that level for longer, we just increased the width of that, taking in the peaks and troughs of that area. So yeah, that's how I like to define my particular levels. So that's that. Hello everyone, I'm back again. So I like to say a level is like a room with four corners. So you've got your four walls, the high and low of that area outside of the impulse that broke the previous area, and the highs and lows are like the boundaries. So we're still in that level until we break out of it with an impulse that breaks and clears these previous highs or lows. So for me, that is how I define my levels. Either it could just be a stop hunt and a break, or it could range for some time. So as I said in this particular flashcard from some time ago, dealer has to clear previous level before we count the next level. We can draw the original consolidation and ignore if he goes outside that level and comes back in. Ignore the part where he went outside. So for example, here, he went outside and then came back in. So we just ignore that. We don't count that as like another level. So from here, for example, we had level 3, then he went to level 1, and then you can mistake this for level 2, but he came back inside it. So all of this then becomes level 1, and then he shifts, and then this would be our level 2 and our level 3. So a dealer can go outside the level and then back inside it, but then he's still forming part of that particular structure. If you look on some of the longer term cycles, you'll see that over and over. And sometimes you see cycles within cycles, even on the higher time frame, and they can easily be mistaken. So yeah, bear this in mind when you look at the charts. I think it might help you. And as you can see here, sometimes the dealer holds these consolidations for a little while. So this is another one of my flashcards that I did some time ago. As you can see here, let me just get my annotator here. During Asia price ranges, and then we have a move, a stop hunt out of Asia into London, and then we have what I called the trend move back then. And then this was like our initial high and low of the day in Asia, and then we made a new low of the day with our stop hunt, and then we made our trend move, our distribution move, and then we made our high of the day here. So this would be our lower day and our high of the day up here, and our HOD up here. And then we finished the day in New York with a retracement back into end the day, and then sideways movement back into Asia to start this whole process off again. So yeah, that could be a typical day in the market. Sometimes it's not as pretty as that, and sometimes they do it over more than one day. So that is something to bear in mind. Just clear drawings. So here we have Asia, consolidation, false move, lower the day W, push 1, push 2, push 3. Sometimes it's not be as pretty as that. Sometimes they'll do a type 3 pattern and move. Then you won't see this lovely pattern. If a dealer keeps doing type 3 patterns, you're literally just going to see price come out of Asia and move. So yeah, you might not even be able to count the patterns and see them so clearly. And sometimes they'll do 2 of these in one day, and sometimes they'll do so they vary it quite a bit. So this is why I'm trying to explain that it's important to not just use one method to count your levels. In a perfect world, yes, we see this, and yeah, sometimes we have to view it on the larger time frame to be able to see it, because on the lower time frame and even in the higher time frame in a fast moving market, we simply don't get the stop hunts or the consolidation. So we have to look at the other methods we understand now. So then we had our London push, and we made the high of the day, New York reversal, and back into consolidation. So we have 1 day of rise, 1 level, 1 IDC, and probably 1 ADR. So WVVM of an intraday cycle is equal to 3 M15 pushes between high of the day and low of the day, ideally. And obviously this would fit inside our A1, and then this would make our A2 kind of thing, you know. So these would be between the higher time frame levels. We'd have our intraday pushes on the M15. Obviously this would, the next day would have a stop hunt, and then this. Yeah, so that's a bit of a better drawing than I just did. That would make our A1 and A2, V1 and V2 even. If we were coming from peak formation low. Yeah, so that is basically what I wanted to cover tonight. I hope it helps, and yeah, hope you all have fantastic trading and a good week. One sec. So this was another flashcard I just wanted to go over. So we have Asia here. The market makers spread is the Asian session for the day. And then we have the initial low of the day, initial high of the day. And then we had our stop hunt in the wrong direction, which was a false move. A session changeover London Open. We had 3 vector candles pushing up aggressively, trying to trap traders and induce them in the wrong direction. We had new high of the day, set the highs, the dealer set the highs and worked them for around 90 minutes in the Brinks, around the Brinks box. Dealer then makes 3 pushes down from the high of the day in London, sometimes into New York, makes a new W. So this is our M, our A, and our W. Then he makes a new low of the day in New York, which is probably equal to 1 intraday cycle. Cycle is complete. And then we have our New York reversal, price retraces back into the range of this cycle here, and then consolidates back into the Asian session. So that would be how one of these days could look. So I hope that helps, guys, and take care. Thanks for watching.